Welcome to the Hawaii Housing Report. I'm Patrick ONeill, broker owner at Luxury Homes International. And with me today, Hawaii's most well-loved economist, Mr. Paul Brewbaker. Paul, how are you?
Aloha, Patrick.
Joining us from an undisclosed location at your Colorado bunker, are you?
Joining from my rainy survivalist Rocky Mountain bunker.
All right. Okay. Well, Paul, there's been more dramatic home sales figures that have come out. We're going to look at that in just a moment. But let's start with the Fed's actions and subsequent comments, which is directly affecting the property market, as everybody knows. So on May 3rd, the Fed raised their key rate another 25 basis points. This, I think, is the 10th consecutive raise since last year. The subsequent comments from Chairman Powell, from what I read, inspired people to be optimistic, and then other people became very pessimistic. Maybe a little bit of a mixed signal there. How did you read it? What do you see? What do you think is going to happen at the next Fed meeting?
I think that at the next Fed meeting, the Fed will reaffirm everything it's done so far, pledge to continue, notwithstanding the emergency liquidity that it provided to the banking system after the collapse of Silicon Valley Bank and subsequent turbulence. Pledge to continue to retain a standby, kind of a status as far as financial systemic stability is concerned, but otherwise not raise interest rates anymore. I think they're going to stand pat. My guess is for up to a year. So this is not going to change quickly, but it's too soon to lower interest rates because inflation remains high. Inflation remains high in the parts of the consumption stream on the services side, which don't benefit from global supply chain rearticulation, right? The goods spending is benefiting from supply chains being restored, but services spending still has a number of upward biases in it, not including what is the deal with tips? What the hell is going on with that? So there are sort of, if you peel away the layers of the onion, there are other layers that are still creating inflation concern that the Fed would like to see subside before they shift position entirely. But moving to a stop as opposed to raise interest rates posture wouldn't be entirely surprising because they've been signaling that they're approaching that point, but would require everybody because there are two sides of the debate on that, and a vigorous debate about that. One side would have to get used to it, and if I'm wrong, then the other side's going to have to get used to.
And let me ask you a question. So right now, let's just say that rates don't move. Next meeting, they say everything's looking good, everything's looking fine. Does that signal to the economy, hey, everything's fine again, let's all go back out and spend, and inflation starts to come up again? Is it that simple?
No, not at all, because the economy is slowing down for other reasons. I think let me just show you the pictures as we usually do. I'll start with the Fed's balance sheet. Nobody talks about this, but you can see the balance sheet was shrinking beginning about a year ago as the Fed began engaging in interest rate increases. This is the quantitative tightening part of their monetary policy tightening. And then a little spiky boost in emergency liquidity to respond to the mini banking crisis that accompanied the collapse of Silicon Valley Bank. But as I pointed out, the inflation, which rose for a year, has now fallen for a year, not as much nationwide as it has in Hawaii. So Hawaii is ahead of the curve. Hawaii had lower inflation throughout the transitory inflation spike. And the question now that the Fed wants reassurance in the form of an answer quantitatively is by how much and when will that 5% consumer price inflation measure for the US and about 5% on the target that they use, which is the personal consumption expenditure deflator after adjusting for energy and food prices.
And the target rate for the Fed is 2%.
Well, the target rate for the interest rate is 2%, but what they're looking for, I'm sorry, you're absolutely right. The target rate for the inflation goal measured by core PCE is 2%. That translates into 2.5%, which I've shown here in the consumer price index. But as I say, that, they're at 5%, you're still 2.5 percentage points away from the 2.5% or 2% that you want to get back into that zone. And we could be there in the next few months if we got lucky. I think almost certainly we're there by the end of this year. But the Fed's not going to get ahead of itself, right? The Fed wants confirmation that we go there. And as a result, the interest rate forecast that they have, which essentially concedes that where we are now with interest rates is about where we'll end up, except for a few members of the voting group that determines the interest rate policy. You can see the blue shaded area goes up much higher to the upside than the group that's sort of below the median there, that are more clustered around the 5% number. There's debate among Fed open market committee members, as well as in the financial markets generally, about whether this is actually ended. But my bet would be that we're done for now, but this will be left in place for long enough that we won't see any meaningful changes until 2024. Long-term interest rates have come down, of course, and we're going to want to talk about how that affects mortgage rates in a second, because there seems to be a bit of a gap now between where long-term U.S. Treasury yields have been moving and where mortgage rates now, since the mini banking crisis, have gotten hung up. There's probably, we'll have to talk to Anders about risk premia and what kind of loans are, what kind of mortgage loans are.
Why don't we segue into bringing in Anders right now? Anders Hostelli from Guaranteed Rate Mortgage here in Hawaii. How are you, Anders?
Oh,
good. How are you doing?
Okay. Doing good.
There we go.
Hey, great to see you.
Yeah.
Let's start with 30-year mortgage rates, fixed year. That's kind of our benchmark to see what it looks like. So let me pull this up on the screen and kind of want to talk a little bit about this with you. So this is the latest data, actually came out today from Freddie Mac. 30-year fixed mortgage, 6.39%. How close is that tracking to what you're actually doing? You're actually underwriting deals right now.
It's pretty right on. So these rates are the conforming interest rates, right? The rates are mortgage rates for a loan in Hawaii that can go up to 1,089,000. I mean, that's our conforming limit in Hawaii. So yeah, they're pretty right on when you look at these surveys, and it's a little bit higher than it was a month ago, mortgage rates, but they've been just kind of bouncing around in a certain range the last few months.
Right. And so we're talking with Paul, Fed kind of signaling maybe this is it for a while, but the bond markets really didn't react and didn't drive this rate down. We're, like you said, just a little bit above last month. That's what you're seeing.
Right.
Yeah. And how about, this is the 30-year fixed. What do you see in the adjustable rates, which I know some people are doing as a short-term answer?
Yeah, the 5-7-year adjustable rate mortgages, they'll be about 0.5% below this, the 30-year fixed.
I see.
If not, maybe even a little less than a spread. I'm seeing the ARM rates, kind of moving up a bit too.
And on the ARMs, those are generally locked in for a certain period of time, right? In the beginning.
Right. It's either fixed for the first 5, fixed for the first 7, or fixed for the first 10. Those are the typical popular ARM products.
Okay. I gotcha. And let me ask you this. I think you are aware that there is a bit of a crisis in the commercial lending world right now because of what's happened with the banks. Do you see any tightening or any new restrictions for residential loans?
We don't, really work within the commercial loan space, but, kind of interesting what you're talking about, because what we've seen or had seen recently is that jumbo rates, and the jumbo mortgages are, typically we'll go to a bank or a credit union or, a national bank that they lend, their money, and it's in the jumbo space above the conforming loan limit. But those rates have in the past, you would see those rates could be even under a conforming interest rate, or under that 6.39 we're just looking at.
Seemed like it was like that all last year.
Yes, all the last year before. There's a lot of liquidity in the market. The banks have, they had a lot of money to lend out. But I just noticed that the jumbo rates, and we were even talking about it on a national call a couple of days ago, that in the jumbos, there's the liquidity is drying up, or it's been contracted. So those jumbo mortgage rates that were before underconforming are now like almost like a 0.5% up above the conforming interest rate right now.
Wow.
Yeah.
So before they were slightly below the conforming rate.
That's what we were seeing. Yeah, that's what we're seeing. Now they're above the conforming rates.
Interesting. And this, you think, is a direct correlation to the sort of banking crisis,
Yep.
we call it, or the credit crunch right now that we see playing out in the commercial
Yeah,
so
absolutely.
heavily.
Yeah, absolutely.
Very interesting. And then, Anders, I know that you look at loan originations and loan lock for kind of where's the health of the market, how many
Right.
deals are coming through. What's happening right now? Any change in the last month or so?
Oh, it's been pretty steady. The from last month or the last 3 months, it's been pretty steady. It felt like we had about a month ago, it started getting a little bit busier, but and it's kind of gone back to that kind of normal pace. I was looking at the national mortgage application, purchase application stats, and week over week. So I kind of look at that a lot, and you'll see that they, like last week compared to the previous week, they're down, but not by significant amount.
So yeah, kind of similar. So, and slow is it's
Yeah.
slower, right? Okay.
Yeah.
Let's go back. You sent me an interesting chart, and this we hear talked about quite often, which is although there's more inventory for sale in Hawaii, certainly, we're going to take a look at that in a moment. There's been less new inventory added, and part of the reason is that the existing homeowners have such good rates on their properties. They don't want to sell to buy something else.
Right.
This is something you sent me. Can you touch on this a little bit, what this is?
Yeah, so if you look at it, we kind of look at the vintage or look at the interest rate note rates that people have on their mortgages right now. So on the top, you'll see it says about 2/3 of mortgages, 30-year fixed mortgages are below 4%. So, if you can imagine, that's 2/3 of the mortgages. So if someone were to sell their home and buy a new home and get a new mortgage, the difference in the rate, and what that would do to their payment, factors into it. We've also seen where buyers are, hey, instead of me selling, if I really have to move, I'll try to hold on to the property I have and rent it out because I have such a low interest rate.
I see. And I've seen the figure, heard the figure. 85% of existing 30-year mortgages are below 5%.
Right. Yeah. I mean, you can kind of see that from this graph, right? But yeah, it's definitely impacting the number of I know you're going to talk about the supply in the market.
Yes. Yeah. And let me ask you this, kind of the magic interest rate. I think it's been tossed around. Once we get back around 5.5, that feels more like a normalized rate, looking for more of a historical context, not the last 10 years, which has been an anomaly. Does that sound right to you? A 5.5 is kind of the normalized market?
Yeah, I think so. Maybe 5.25, maybe the low fives.
I see.
Yeah, I would say so. I know there's a lot of people that are still hoping for under 5%, but I don't think I can't imagine we'll ever see 3% rates again, or fours, low fours, but we shall see. Yeah.
We shall see. Okay. And then your Anders prediction, when we get to 5.5, when do you think that would be? Is that going to happen anytime this year?
I think we could see that by the end of the year, definitely. Yeah.
Oh,
Yes.
really?
Yeah, I do.
And what gives you that optimism?
I think what we'll see is, again, this is just my opinion here. As the Fed stops raising rates, that will, signal to the market that, okay, inflation is under control. Once, inflation is under control, that just, will drive mortgage rates down because, mortgage rates are tied to obviously the 10-year treasury.
Okay. So always like to end with you a little speed round of questions.
Sure.
So question number one, will interest rates be at 5.5 or less by December of this year?
Yes.
Okay. Eastern Regional Finals, Boston Celtics or Miami Heat?
Celtics.
Okay. Western, Lakers or Denver Nuggets?
Denver Nuggets.
Okay, all right. We'll
All right.
check with the judges and I'll
All
get
right.
back to you later how you did on those. Hey,
All right.
Anders,
Appreciate it.
thank you very much. It's
Thanks
always
for
a
the invite.
pleasure. Yeah, the information is fantastic. Have a great day. We'll see you soon.
Thanks.
Okay, and don't go away. We're going to be right back with economist Paul Brewbaker. And welcome back to the Hawaii Housing Report. I'm Patrick ONeill, joined by my favorite economist, Mr. Paul Brewbaker. And Paul, it's always great to have Anders on, and he gives us some real world data, what's happening out there. Do you have any other comments about
Somebody who
what
actually works for a living, you mean, making mortgages?
Not just hiding out in
Not
his
just
Unabomber
talking about them like
shelter.
me.
That's right. Yeah, but do you have anything else to add regarding
Yeah, I
interest
think
rates or
he
where
raised
things
some
are
really
headed?
good points about how rates are kind of sticky right now. Let's go back and take a look. This is a slightly different version of the data he was sharing. Freddie Mac has what they call a legacy series, where you sort of calculate the data the way they used to. They have the newer data come in about 6.4%. This data set comes around 6.5% for the 30-year fixed rate mortgage. But the point is, you can see how after peaking around 7% in November, it came down pretty fast, and now it's sort of wobbling in that same zone from maybe 6.2 to 6.5 or 6.6, you know what I mean? And it seems kind of stuck. It seems kind of hung up. Well, it turns out that Treasury yields are also kind of hung up. This is the yield on the 10-year US Treasury note. And you'll see back here in November, you follow the arrow jumping around. Back here in November, you had a 4% 10-year yield. Then it came down to about 3.5. And then it's been bouncing off that 3.5, bouncing off that 3.5 to recently in, mid-May, it's been about 3.5. So at the long end of the Treasury yield curve, interest rates can't push through. They're, instead of the way the way inflation has been declining, the longer term interest rates, where there's an inflation premium, right? There's an expected inflation premium. Those rates have, so let's say, gotten stuck at 3.5%, and so the mortgage rate has got stuck in, let's call it 5.5%. I'm sorry, 6.5%. Two things about that. One, a spread from 3.5 to 6.5% between mortgages and 10-year Treasury note yields is large. It's usually 2 percentage points, not 3. 6
And
minus 3
that's
is
the
3
risk.
percentage
That's
points.
the risk premium.
Let's decompose. Some of it's probably risk premium. There are risks in the housing market. Prices after the pandemic maybe got a little frothy. There are dislocations in the labor market. A lot of people working from home now that lead us to be unsure about if they're going to ever show up to the office, but also what that means for the values of houses. We haven't sorted that out. And then there's the point you were alluding to a second ago, which is that because so much of the housing or the mortgage debt, residential mortgage debt in America, was repriced around a 3% mortgage rate rather than a 6% mortgage rate, many people are loath to even list their homes because what they would have to pay to move into a new home is so much more costly to finance it, even
Sure.
if they're leveraging some of their equity forward. So
Yes.
there's this kind of, we're sort of hung up,
Right.
moving towards a restoration of the Fed's inflation goal over the next year or two. Anders' expectation that interest rates will be 100 basis points lower from, let's say, 6.5 to 5.5 within the next 6 months. An opinion I would share.
Oh,
And then a
good.
debate, as Anders
Yes.
suggested, about
Sure.
whether it'll ever get below 5. I think
Right.
so. Getting hung up as we are, he's starting to think maybe not.
Yes.
And
Okay, so there's
yeah,
actually two pieces that are going to help the mortgage rates. One is the
yes,
premium, what we call it risk premium,
the
whatever we want to
risk
call that,
premium, yeah.
plus the inflation rate coming down. So
It
these are
turns out,
real. Mhm.
yes, it turns out there's one more factor in the banking system that's problematic because of these collapses of Silicon Valley, First Republic, and Signature Bank, and it's just the ripple that's blasted through mostly the regional banking system, where the local banks in Hawaii, for example, dwell in terms of where they are in the system. And what's happened is that funding has gotten more expensive for them, right? The way they fund their loans, which of course they have to pay deposits, which are more
and that's
expensive.
why the jumbo product, which you told me
One
before,
reason,
generally is regional, right? And then but we have the secondary markets, Freddie and Fannie for conforming. Those
correct.
rates continue to be the best rates.
Yes, and the jumbos
Yeah.
are parked on the originating bank's portfolio, which, as we've seen
Yes.
after SVB, is exposed to risk that in that case wasn't properly managed, or may
Right.
not have been properly managed. But in other, even in healthy banks, represents a risk management problem. Although at this
Yes.
point, with rates likely to go down rather than up, maybe
it'll start
maybe
to become less of an issue. Okay,
well, it'll become more valuable if you can actually originate
right. Yes.
a credit-worthy jumbo loan right now with a
Yes.
6% handle on it. Imagine what
Right.
that'll be worth when interest rates
Right.
are at 3%. Well, not that much, because that guy's going to
He's going
exercise
to refi
his
it.
option
He's
to
going to get
refi.
out.
So
That's right. Okay.
he's no
Let's
dummy.
move on. Yeah, let's move on to the housing statistics from
Yeah.
the Honolulu Board of Realtors. First thing I want to look at is closed sales. And before we look at the numbers, I just want to give this a little bit of color. Two of the biggest declines in home sales in Hawaii's history. One is after the so-called Japanese bubble period. We saw a decline of 30%. The other was after the subprime market. I think the annual
30
decline,
30 for condos.
30 for home. This is not pricing, but actual number of sales. Number of sales. The number of sales, closed sales. Okay. And then for the subprime, I think it was right around 24% decline in the number of closed sales. So let's jump over now to the statistics.
We just
from
had
the
the same
Honolulu Board
thing
of
in the
Realtors.
last year, didn't we?
So here we go. Honolulu Board of Realtors statistics. These are the latest numbers that have just come out. Up
Yeah.
at the top, we're seeing month over month change.
Right.
And more importantly, if we look at a little bit bigger data set, is the year to date. And I put the previous other declines here in the lower right-hand corner. You see 1991, 30, 2008. This is 39. We're tracking at 39% for the year. If this continues, this will be the biggest drop ever in closed sales in the state of Hawaii. Do you see any reason why, why this wouldn't continue?
Because by December, we'll be comparing to last December, at which point sales had already fallen. So the average for the year 2023 is not over. We'll get 6 more months of data. We'll get year-over-year comparisons that are more akin to what we've seen recently. But it's still going to be
This all began March of last year when the rates started going up.
Exactly.
So we're gonna have that little section where perhaps the declines are a little bit less. Okay, Paul, let's take a really quick break, and we come back. I want to jump into pricing, what's happening right now, and then also again, kind of looking back historical to the other two corrections to see where they went. So stand by. We're going to be right back with economist Paul Brewbaker.
Sounds good.
Hello, and we're back with Hawaii's Unabomber economist. What the hell is going on? We got Paul Brewbaker in his lair somewhere deep in the mountains of Colorado.
Quick change.
I love it. Quick change. While you do that, Paul, I'm going to pull up the housing statistics from the Honolulu Board of Realtors. You're not coming to my house.
Okay, I'm back. The future's
like,
so bright. I gotta wear shades now.
Okay, you're back. All right. Okay, let's jump in. We're going to go back into the Hawaii HI Tetra Honolulu Board of Realtors statistics, and let's jump into active inventory. So this is pretty interesting. I mean, we hear across the country and we hear in Hawaii a lack of inventory. But the reality compared to last year, it's up 35% for single family homes, up nearly 25% for condos. So yes, there is a lack of inventory, but there's certainly more than there was last year. If we look at new listings, this is what we've been alluding to with the friction cost of someone selling their home now and getting a higher interest rate. Now, when we look at active inventory plus the closed sales, we get this pace. We end up with month supply of active inventory, 2.1 for homes, 2.5 for condos. We've talked about this at great length. That's typically emblematic of a seller's market, correct?
In the recent past, correct? Yeah.
Yeah, yeah. So I don't know where we are right now. I can say that out there, if you're a buyer, it still seems like there's lack of inventory, but there is more inventory on the market. And depending on the building, the neighborhood, et cetera, it does seem like there's some deceleration in pricing.
Well, you have to
So
be a
what?
little careful with that, Patrick, because you can see that new listings have fallen in both single family homes and condos in the last month, and then similarly for year to date. What's happening is that sales are falling faster than listings. You see what I mean? So listings
Yeah.
are falling, but sales are falling further. So the inventory is piling up. But both sides of the market have retreated. And this goes to the point we were talking about with Anders. When you look at everybody's locked into these low rate mortgages, and they're kind of like, why would I buy a new house? Why would I sell my house and then have to buy a new house when I would have to pay 6.5% or something, 640? So that, it's going to be a problem. The inventory in the historical context of 2 or 2.5 months is actually relatively tight, but
Mhm.
it's just quiet. It's just the crickets are chirping out there, and rates aren't falling right now fast enough to rejuvenate um, the market more quickly. It will quicken, but it's going to take a while.
Yeah, and I'll point out something. We don't have to talk about it in great detail today, but there's a whole segment of, especially our luxury market, that's missing, which are the Japanese visitors coming to Hawaii. At our
Yeah,
peak, we had 1.5 million visitors a year.
yeah,
Last year, we had less than 200,000. And then, of course,
yeah.
the yen to the dollar, it's about a 30% change
A tough one.
unfavorably. Yeah, it's a tough one. So
What is
that
what one
also.
135 yen per dollar or something like that? It's just
Yeah, that's exactly right. You're exactly right. Yeah. So, okay, well, let's continue on then, and we'll look at pending sales. Not a big surprise here. It's just kind of what we're going to see next month as well, down 26% for homes. Yep, down 34% for condos. So we're going to see that continue to decline. Let's jump over into median pricing, and I think there's something interesting we want to talk about when we look from a historical context. But let's look at the current numbers. Month over month, down 9.5 for homes, 2% for condos. If we look at year to date, single family down 8.2, condos down 2%, almost flat. I mean, almost
mhm.
insignificant in the condo market from a median price perspective. Uh, Homes which inflated so quickly during the COVID period seem to be correcting just a little bit. So, Paul, this is what I wanted to talk about for a moment. I've
Yeah.
heard this every single real estate market I've worked in across the country, the international markets. Everybody says, here, our real estate never goes down. It only plateaus and continues to go up because fill in the blank. I've heard that in every single market.
Yeah.
I hear that in Hawaii again right now. The reality is pricing does go down in Hawaii, sometimes nominally, but there are cycles to it. If we look back historically, let's say the 1990s or the last one, 2008, what sort of price corrections were we looking at?
Well, historically, 20% in decreases in median prices in the 90s, another 10% after the subprime financial crisis. So between, let's say, 2007 and 2000, the early 20 teens. So it's true that every market is different. Each market has different characteristics. Every neighborhood does. Every house does in that sense. But these cycles are shared, but they vary tremendously. So, for example, you look at a market like Las Vegas or Phoenix, Arizona,
Right.
which had a massive subprime bubble in asset prices, and then a massive collapse.
And California. And those were non-recourse
South
loans. They were
Florida, yeah,
100% loans. Everybody said, what the heck? And they just gave the keys back at the end. Yeah, in those markets, some of those we saw 70% decreases in Orange County.
but those markets experience varied. We're at one extreme of outcomes, whereas Hawaii, it turned out, was in a in a relatively um, less exposed position. There had been fewer subprime mortgages underwritten as a share of the total. The local bank and mortgage lending players weren't as aggressive in that market segment as were some of the big mainland names that kind of specialized in subprime lending. And that was a pattern you saw around the country where markets, regional markets that were exposed to the downdraft of home prices collapsing after the financial crisis began in 2007, 2008, those markets, in many cases, were disproportionately served on the lending side by these aggressive subprime lending,
And we don't see that right
national
now.
banking
That's certainly
organizations.
not
We don't
happening
see
now.
anything like that
No.
right now. Absolutely
So,
not.
so the big question we all want to know: are prices going up? They're going down. Should
Yeah.
I sell now?
Well,
Should I wait? Should I buy
look,
now? Should I
let's
wait? What's the answer?
let's look at what we're talking about in context. And here I've bear with me a little bit. I've taken out the inflation here so that we're not confused by the fact that prices were rising 7.5% in Honolulu or in Hawaii a year ago. This year, they're only rising 3%, 3.3%. Let's just take all of that out. And what you have when you remove the inflation from a housing valuation index like the one published here by the Federal Housing and Finance Agency is a long-term trajectory wherein those previous cycles are clearly evident. The Japan bubble, to which we referred earlier, the subprime bubble, not as bubblicious as the Japan bubble, but nonetheless a profound increase and decrease in the real value of homes in the aftermath of each of those bubbles. Well, compare that to what we've been through, both in the modest surge in the 20 teens and then what I call the COVID mini bubble, which hasn't completely unwound. Those really, I know there are a lot of people concerned, when median prices, like in this next slide, when median prices got up over $1 million, people were really concerned on the single family side because they punched up so quickly from around 900,000, at the time of pandemic to right straight to 1.2 million. And you would say, wow, but that's 20%. Well, it didn't last. And what's striking is how much even those prices, which inflated much more than condominium prices did in the post-pandemic surge, how much those prices also have an appearance of reverting to the longer term trend. So again, this is probably good advice for a home buyer in general, that unless you really have to move because of a new job or a change in your marital situation, or your children are going to go to a different school on a different island or whatever, life decisions matter. But otherwise, think of housing as a long-term investment, and tactically about how close or far away you are from that long-term trend. If you're way above this, if the cycle's taking you way above, you have a different approach than if you're way under. And then don't forget that the mortgage interest rate environment makes a huge difference, as we all know, because we just lived a 3% mortgage and a 7% mortgage back to a 6.5% mortgage in 12 months. That hasn't happened in 40 years. As I like to say, half the people in Hawaii were never alive, have never lived at a time when that happened until now.
Interesting, right? But yeah, that's true. And a lot of people in the business have not seen anything other than a
A lot
upward
of people.
sloping market and low rates.
Has your career been going on for more than 40 years? Then this is a first for you too.
Oh, I see. Right. You have to see the rates change that quickly. Okay, Paul, let's move on to our speed round. By the way, if
Yeah.
you're watching this video on YouTube and you're enjoying the information, please hit a thumbs up below. Subscribe to the channel. Make sure that you get next month, and give Paul some social media clout.
I feel like we
Okay,
say the
Paul.
same thing every month, but I'm sure someday it'll change.
Oh, you mean you seeking your social media clout? Yeah, no, I always
Well, no, or just just sort of, oh yeah, I'm sure interest rates are going to fall, and then next month
That's
you go, I'm
right.
sure interest rates are going
That's
to fall.
right. That's
But that's
right.
not half as bad as the guys who, I'm sure there's going to be a recession in the next month. I'm sure there's going to be a recession. It's like, okay, I'm
Yeah.
tired
Well,
of
just
waiting
keep
for the
saying it
recession.
long enough, it'll come through.
Yeah, there
Okay.
you go.
Let's go
Lightning round.
lightning
Here we go.
round. Okay, here we go. Lightning round. Okay. Home prices, December 2023. Same,
Oh,
higher, lower?
December 23, same as now.
Same as now. Okay. All right.
Yeah.
Okay. When will interest rates hit 5.5%?
Sorry, same as now on a seasonally adjusted basis. 5.5%.
Yes.
2023 year end
Oh,
ish.
good. Okay.
Yeah.
Okay. Well, I'd like to hear that. All right.
I
Okay.
think I really think there's going to be a breakthrough this summer and this fall, and it could involve a recession. Let's be clear about that. There is a recession risk, and it's about a 50-50 shot. The more likely the recession becomes, the more interest rates will fall. Yeah.
All right. Okay. And then NBA Finals, Lakers or Denver Nuggets?
I didn't even know the Nuggets are in the finals, and I could go to a game.
That's the
So,
wrong answer, by the way. Just checking the judges. Okay, let's see if we get this one right. Boston Celtics or Miami Heat?
oh, Boston.
That's also wrong. That's surprising. Got both of them wrong today, Paul. Hey, it's
Uh,
always a pleasure.
yeah.
Always have some great laughs and learn so much seeing you. Good luck there in your undisclosed location in
Yeah.
Colorado.
I
And
was just putting the gun rack up in my pickup truck when you
good
zoomed in,
man,
so
good
I'll have to go
man.
get back to work on that.
All right. And for everyone else, thank you for watching. Be well, take care, and aloha.
Aloha, everybody.